Hello and welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, before I start this show in earnest, if you enjoy this show, find it useful in any way, then please make sure you hit that like button on YouTube and you subscribe to our channel. Now, in last month's episode, I highlighted how commodity prices could help answer the question of whether central banks will carry on tightening monetary policy to combat inflation and cause a global recession, or whether inflation had already peaked. If we look at commodity prices and how they fared during July, then on the whole, they continued to tumble. But by way of example, the price of crude fell 10%, with most other commodities also struggling. But there's always an exception, such as natural gas, which rallied more than 50% as a result of Russia's rationing of supplies to Europe. Copper, which is a good economic indicator, as I mentioned last time, plunged 16% during July. Now, the continued plunge in commodities can be interpreted as being a result of increasing recession fears, especially when central banks like the US Federal Reserve seem hell-bent on increasing interest rates to combat inflation. Interestingly, the Bank of England became its most aggressive in 27 years when it hiked its base rate by 0.5% to 1.75% at its August meeting. Not only that, but the Bank of England even predicted that the UK economy would enter recession later in 2022 and remain in one until 2024. Now, the Bank of England has caught up with what commodity markets have been telling us for a while, yet in the US, officials seem to still be struggling with the recession risks. Somewhat bizarrely in the US, they have experienced 2 consecutive quarters of economic contraction, which has always been the widely accepted definition of a technical recession. But this is now being largely dismissed by officials and the goalposts are being moved. Now, the increased likelihood of a recession in the US and globally has seen the market narrative shift significantly in July. Previously, the belief was that the Fed and other central banks would hike interest rates and ultimately crash the economy with the sole focus on bringing down inflation. With the market desperate for signs that the Fed might pivot from hawkish to dovish, investors jumped upon comments from the Fed chair Jerome Powell just after he'd hiked US interest rates once again in July. And those comments were to say that the interest rate path would be led by economic data and they were removing any sort of future guidance. Now, with the removal of any kind of future guidance on where interest rates would go, by just saying that it would be reliant on future economic data, markets interpreted this as a dovish pivot from the Fed. And to use an analogy, the market had previously believed the Fed would keep the accelerator pressed down firmly until it caused a crash, but it now believes that the Fed has decided to change tact, take its foot off the pedal and become more reactive, so avoiding crashing the US economy. All in all, it means that the market interest rate predictions have tumbled and the market is no longer assuming that rates will head higher regardless of the damage to the economy. Now, this was positive for US tech stocks and bonds in particular, but of course, such is the power of the Fed that similar strong moves upward were seen on global stock markets and global bond markets. If we look at the returns of different equity markets globally during July, we saw some of the biggest monthly performances since late 2020. The FTSE 100 rallied 2.34%, the German DAX rallied 5.29%, the Nikkei rallied 5.51%, and the S&P 500 rallied 6.85%. But it was the US tech stocks where the FOMO, the fear of missing out, really took hold. The tech-heavy Nasdaq 100 rallied 11.36% in July. Now, while the lower interest rate expectation gave US technology stocks a boost, on top of the supposed Fed pivot, signs that US tech earnings were weathering the economic slowdown better than expected also lit a rocket under technology stocks. Now, in particular, Apple sales and profits beat analysts' expectations, and it was also positive about the prospect for future revenue growth in the next quarter, which sent Apple's stock price higher. And as goes Apple, so goes the market, according to the adage, which often proves valid given the outsized influence that Apple stock has on the S&P 500. Apple has a weighting of 7.1% in the S&P 500 index, which is a huge amount. It also is the largest component of the MSCI World Index with a weighting of 4.54%. So Apple matters. It means that the S&P 500 has rallied an impressive 13.23% since its bear market low on the 16th of June 2022 and broken out of its downtrend dating back to the spring, as investors think the central bank rate hiking cycle will be less severe than they had previously thought. So is this stock market rally finally sustainable, or is it just another bear market rally? After all, we've seen a number of false breakouts this year already. Not only that, but there is still a strong argument that we are in a downtrend dating even further back to the November 2021 highs. If we look back at the bear markets that started in 2000, which was the dot-com crash, and 2008, which was the financial crisis, the largest bear market rally was 23%. Now, this happened between November 2008 and May 2009. So certainly the current rally in equity markets could have much further to go. But after that 23% rally back in 2008 and 2009, the S&P 500 fell more than 27% before hitting the ultimate bottom achieved during the financial crisis bear market. So the message is that the size of the current rally doesn't really tell us anything. Ultimately, recession is still likely to be the main thing that markets focus on in August, unless, of course, geopolitical tensions relating to Ukraine, Russia, or China and Taiwan ratchet up. Of course, equity markets always tend to front run the economy and rebound far sooner than the bond market. But the bond market is definitely not convinced that the economic outlook warrants such enthusiasm as we've seen in equity markets over the last month. The US yield curve is the most inverted since the year 2000, and equity markets tumbled back then. And the 10-year US Treasury yield currently has fallen to its lowest level since April, which is near 2.5%. So in August, we are likely to find out whether equity markets are being too optimistic about the future or whether bond markets have become just that bit too bearish. So if you've enjoyed this video, please make sure you hit that like button on YouTube and don't forget to subscribe to our YouTube channel. And I look forward to seeing you next month on Damien's Market Update.